All right, let's get right into the latest from Destination XL. That's ticker DXLG. And wow, this is not your typical earnings report. It's really a tale of two completely different stories, and they just slammed into each other with this announcement.
So on one side of the coin, you've got their standalone business, which, honestly, it put up some really tough numbers. We're talking big misses, clear signs that their core customer is struggling. If that was the whole story, this would have been a pretty rough day for them.
But then management drops an absolute bombshell, a massive merger that just completely flips the script. It changes everything, the whole investment case, the sheer size of the company, its entire future. You know, this deal just blew everything else out of the water.
So that leaves us with the big question, right? How in the world do you weigh a disastrous quarter against what could be a game-changing strategic move? Is this a buy or is it a bust? That's exactly what we're going to break down.
Okay, first things first, let's talk about DXL as a standalone company. And, well, it's not a pretty picture. The performance in Q3 was just weak, plain and simple.
So, the big headline number? A GAAP earnings per share loss of 8 cents. And let me tell you, that was a huge miss. The street was looking for a loss of only 5 cents. So they came in a whopping 60% below what everyone was expecting.
And the sales pressure? Yeah, that was just as bad. Comp sales dropped 7.4%. And this wasn't just one area weakness either. Their store comps were down over 5%. And the online business, that fell off a cliff, down a sharp 13%.
Then you look at profitability, and that took a major hit too. Gross margin, it collapsed by 240 basis points compared to last year. A big part of that was what we call occupancy deleverage. Basically, their sales fell, but their rent didn't, right? So those fixed costs hurt more. On top of that, their actual merchandise margins got squeezed a bit too. It's a serious problem.
So what's going on here? Well, management was actually really upfront about it on the call. They said their core customer, the big and tall guy, is feeling the economic pinch. He's shopping less, and when he does, he's trading down to cheaper stuff. It's just a tough environment for their specific consumer right now.
Okay, so just as the market is trying to figure out what to do with those terrible numbers, bam, the company announces this massive merger of equals with FullBeauty Brands. This isn't just a small deal. It's a move that creates a totally new company.
And I mean, look at this transformation. It is absolutely stark. DXL goes from being this niche, sub-$500 million retailer to being a key part of a $1.2 billion powerhouse in what they're calling inclusive apparel. This is a pure play for scale. It's that simple.
So how does the deal work? It's all stock. When the dust settles, the current DXL shareholders are going to own about 45% of this new combined company. FullBeauty's owners will have the other 55%. And for those of you watching the ticker, it's going to keep trading as DXLG. And here it is, the magic number, the one that gets Wall Street really excited. Management is targeting $25 million in annual cost savings, or synergies, by 2027. They think they can get there by being smarter with sourcing, cutting overhead, the usual stuff when you combine two companies.
But, building a giant like this isn't free. And this deal comes with a huge change to the company's balance sheet. This is exactly what all the analysts wanted to talk about on the earnings call.
So here's the catch. When this deal closes, the new company is going to be carrying about $172 million in debt. Now you have to remember, DXL has been running with zero debt. So this is a massive, fundamental shift in the company's entire risk profile.
And listen, this isn't just any old debt. This is expensive debt. The interest rate is LIBOR plus 750 basis points. In today's world, that's a huge annual cash drain. We're talking over $20 million a year just in interest payments. That's cash that can't be used for anything else, and it really limits their flexibility.
So, with that giant, expensive loan on the books, how does management possibly plan to make this work and actually create value for shareholders? Well, they laid out a pretty clear game plan.
It's really a multi-pronged attack. First, and most important, they have to hit that $25 million cost-cutting target. No excuses. Second, they're looking to grow sales by cross-selling. Sell FullBeauty's women's stuff to DXL's audience and vice versa. They also think they can use DXL's physical stores as a hub for FullBeauty's online brands, which is a neat idea. And they're really talking up their FiTMAP body scanning tech as a secret weapon, especially with all the buzz around GLP-1 weight loss drugs changing people's sizes.
All right, we've seen the ugly quarter, we've seen the massive deal, we've looked at the potential synergies and the very real debt. So, now it's time. Let's put it all together and make the call.
You know, the whole debate here really boils down to this. The bulls are going to tell you, hey, this deal creates a monster, a dominant player in a niche that's hard to compete in, with clear targets for cost savings. But the bears? They're going to fire back and point to the huge risk in actually pulling this off, the mountain of expensive debt, and, oh yeah, the fact that the core DXL business is still bleeding.
So where do we come down on this? For now, we're calling it a market perform. Look, the strategic thinking behind the merger makes a ton of sense. It absolutely creates a stronger company for the long haul. But you just can't ignore the risks right now. The debt is high, pulling off these synergies is going to be tough, and the original business is still weak. The risk and the potential reward just feel balanced, right down the middle.
But if you're looking for a more interesting way to play this, our outrageous but plausible trade idea, it's not about just buying or selling the stock. The real play here, we think, is a pairs trade. You go long the new combined DXLG after the deal closes, but you hedge that bet by shorting a basket of boring, middle-of-the-pack apparel stores, the ones with no real edge. That way, you're making a very specific bet. You're betting that this team can pull off the merger and dominate their niche, while betting against the rest of the weak retail sector.
And as always, a quick reminder, this is not financial advice.